The U.S. government has reclassified essential minerals like cobalt, copper, silver, and rare earths as critical minerals. This move is driven by a strategic need to secure supplies crucial for defense and advanced technology, and to reduce dependency on foreign supply chains. They are currently in discussions with Orion Resource Partners to establish a multi-billion-dollar fund, potentially $5 billion, specifically for critical minerals mining projects. The reclassification of silver and platinum as critical minerals is expected to trigger massive investment into these sectors as global entities vie for diminishing resources. Industrial giants like Tesla, alongside major investors, hedge funds, and even the U.S. government, are now engaged in a fierce competition to secure dwindling supplies of these vital metals. The scarcity of silver, a naturally diminishing product, is a key factor in this global scramble. For thousands of years, the silver-to-gold ratio has moved from 16.1 to 7.1, reflecting this depletion. The market is waking up. Big money, particularly from BRICS nations, is demanding physical delivery. Consider the London Bullion Market Association, LBMA, often seen as the global delivery mechanism for silver. This extreme tightness is further evidenced by London's one-year implied silver lease rate, which has soared to between 5% and 6.4%. Historically, these rates are well under 1%, rarely breaching it even briefly. Such an exorbitant lease rate signals an extraordinary scarcity and indicates that current silver holders are demanding unusually high compensation to part with their metal, even temporarily. Paper claims are crumbling, and all types of investors are desperately seeking physical silver. The combination of silver being added to strategic mineral lists, vanishing deliverable supplies, and industrial and investment demands colliding is setting the stage for massive upside potential. From a technical analysis perspective, silver is at the cusp of a 45-year cup and handle pattern. The cup represents the peak of $50 in 1980, and the handle is the consolidation and tightening since 2011. Once the price breaks above the cup's rim, which is above $50, this powerful pattern signals a new secular bull market. The rule for calculation suggests an initial target of $90 to $100 for silver, representing a release of 45 years of suppressed energy. Beyond silver, gold is increasingly seen as integral to a new monetary system. Companies like Tether are directly engaging with miners, signaling a shift in financial power dynamics. The current global strategy appears to involve weakening the dollar. By entities like Tether buying U.S. treasuries, interest rates are driven down, strengthening the bond market while simultaneously channeling proceeds into strategic gold and Bitcoin reserves. This pushes up the value of alternative assets while strategically devaluing the dollar. It's becoming clear that relying on dollars is a losing proposition. Nations no longer desire U.S. treasuries, citing weaponization, unchecked inflation, and the U.S. government's inability to manage its balance sheet. With the U.S. printing an astounding $1 trillion every 100 days, the consequences are inevitable. Attempts to lower front-end interest rates ultimately backfire, leading to higher long-term rates and the destruction of the bond market. This is a very dynamic period, and all signs point to gold and silver becoming central to this administration's macroeconomic strategy. The manipulation of the market, once seemingly endless, is rapidly approaching its drastic end.